Hi, this is Chris Buteau with Capstone Home Loans, and I'm coming to you with the Mortgage Minute on behalf of the Daniel Goheen real estate team. And I want to talk today about refinancing. And everybody always asks me, what's the rule of thumb? Should I refinance or not? And of course, now that rates have taken a little dip at the beginning of this year, toward the end of last year, and you're going to start getting inundated by people who have revved up their refinance marketing engines. It's good to have a basic understanding of how do you evaluate that, and people always want a rule of thumb. And the bad news is there is no rule of thumb, because everybody's situation is different, and there are a number of different things that you need to consider in order to determine whether you should refinance or not, and it really can't be reduced to a simple rule of thumb. But the good news is that ultimately the analysis, once you've identified your specific situation, isn't really that complicated. And basically there's a few things that I like to consider. But basically I have a twofold test when I'm advising clients whether or not they should refinance or not. And the first for me is, this is me independent of your circumstances, is I look at it and say, can the cost of doing so be recouped within a couple of years? Because once you start getting further out from that and you're incurring cost and the hope for anticipation of benefiting in the future, the benefit gets a little bit more tenuous, and I have just a more difficult time recommending that. Doesn't mean you shouldn't do it, absolutely, but that's the threshold that I look at first to say, yeah, I think you should evaluate, if I can recoup the cost within 2 years time frame. But even if you can do that, then the next level of analysis has to do with really your gut feeling, and that's something that really can't be quantified, because you may look at something and say, yes, on paper this will pencil out. Within 2 years I'll break even. I think I'll be in this house for 5 more years, and so I'll be money ahead. And that may be true, and that may bear out to be what in fact actually occurs, but it still may change your life enough to really justify going through the process of refinancing. So maybe it pays for itself over a couple of years, and then you benefit, $20 a month or something over the next 2 or 3 years. And maybe that's meaningful, and maybe you're disciplined and will do something really meaningful with that. But for a lot of people, they'll look at that and say, it's just not worth the time. So that's really a gut level analysis. And then also, it depends in part on what your motivations are. Are you just simply looking to get a lower rate, taking advantage of lower interest rates in the marketplace? Do you want to lower your mortgage payment? Because you can lower your mortgage payment without actually improving your cost. You may actually take a higher rate but lower your payment because you're spreading it out over a longer period of time. As long as you know that's what you're doing, and that motivation is stronger than the motivation to retain a lower interest rate, that's an okay thing to do. Or maybe you need cash out for some reason, of course, and that's another level of analysis. So typically I just tell people, let's look at your specific situation, let's look at your loan, what are your motivations, let's calculate the cost, and let's see how long it would take to break even if we're just simply looking to lower cost, and then we can make the recommendation on that basis. Something everyone should consider, if you have mortgage insurance, if when you bought the house you put less than 20% down, you had mortgage insurance, you ought to at least evaluate your loan every couple of years anyway to see whether or not you can get that mortgage insurance removed. Mortgage insurance is removable if you had a conventional loan, not necessarily on an FHA loan. But if you have it, you ought to know how much you're paying for it, and then evaluate whether or not your house is appreciated sufficiently in order to have that mortgage insurance removed. And the process is not that complicated. There has been some federal oversight of this over the last several years, and so lenders tend to be pretty receptive to those inquiries. You may have to demonstrate value, if you're claiming that your house is now worth such that your loan is less than 80% of the value of the house, and you want mortgage insurance on that basis to be removed. You might have to pay for an appraisal, and generally you have to wait 2 years. If you're relying on market value appreciation to remove your mortgage insurance, you have to wait at least 2 years from the time that mortgage insurance was placed in order to do so. If you have an FHA loan, that's a different thing. Since June of 2013, FHA mortgage insurance is not removable if you put less than 10% down, which most FHA borrowers do put less than 10% down. So it's not removable, period. Still something worth looking at as to whether or not you should refinance, factoring in that you could remove that mortgage insurance only by refinancing. But you can't simply say, look, I've got value now, that should be removed, because that went away in 2013. So anyway, those are just some tips about questions about refinancing. You're surely going to get some mail, email, and all manner of different type of overtures with regard to that in the next couple of weeks and months. And if you do have specific questions about that, I'm happy to help you evaluate. Thanks so much. Bye-bye.